Putting a value on sweat equity in your farm business. I'm Michael Langemeier, professor with the Center for Commercial Agriculture in the Department of Agriculture Economics. Joining me today is Denise Schroeder, County Extension Director from White County. As always, if you have questions during the webinar or after the webinar, feel free to email me at the email that's on the screen here. I'll be checking emails about halfway through the webinar and towards the end of the webinar. But if you have questions that you have later on after the webinar is over, by all means, go ahead and send those questions to me, and we will get those answered as soon as possible. The outline of the presentation here is really quite simple. Before we get into the meat of the webinar today, sweat equity, I want to talk a little bit about the interaction of family and business. Most farms are family farms, and so that does create some challenges. Of course, there's some real benefits to having a family business. The family gets to work together and is close to one another, lives close to one another, and so there's a lot of benefits from family businesses, but there is some real challenges there. And so I want to talk about the interaction of family and business before we talk about sweat equity. I also want to talk about a very important topic, particularly if a younger member is coming back to a farm, is to really think about how to divide business income. Now, how much income is the younger generation going to get? How much income is the older generation going to get? And how can we come up with a formula to think about how income can be divided? I think these topics need to be addressed before we can really talk about sweat equity. The main part of this presentation is an example, a very simple example of how to calculate sweat equity for a case farm. And so that'll be a major part of the webinar today. So let's talk about some important concepts, Denise.
Okay.
First, how is a family farm defined? Maintaining family ownership of farmland is not the same as maintaining the family farm. And so we have the family and we have the business. And these are interacting with one another. And so we want to talk about how the business is different from the family. The former, ownership of land, is an investment in a very illiquid, long-term, appreciable fixed asset, specifically land, but also to some degree storage, buildings, and machinery can be long-term, appreciable fixed assets also. And so those assets are not something you necessarily want to sell from one generation to the next. And so we have to figure out, how do we keep these assets in the business if we have some younger members that want to come want to be part of the business? How do we keep these assets in the business and grow the business over time? And how do we keep the family members happy? I smile at that because sometimes that can be a real challenge in a family farm situation. So if inheriting farmland creates a farmer, analogy I want to make here, that inheriting economic books creates an economist. Just because I'm going to give some economic books to my three daughters does not make them economists. In fact, they're scientists. They all have biology and chemistry degrees, and so or either have them or that's where they're heading. And so just because they have some economic books does not mean they're economists. And the same was with farmland. And so there's more to the family farm than just the assets.
So Michael, how do we treat the farm as a business?
This is a real challenge and a question we get quite often, Denise. And one of the things we can do, and I know you talk about record keeping in your work, one of the things we can do is have a separate checking account for the family and business. I think that's pretty important if we want to track costs in the business fairly accurately. And so that's one of the things we can do. Another thing we can do is when a family member comes back to the farm, and even the family members that are already there, I think having an outline or detailed job descriptions are important. So we know what each family member in the farm business does. If we have some non-family members that have investment in the business, we can also define what their role is. In today's farms, there's quite a few assets in the business. Sometimes some of the assets are owned by non-farm family members, and so keeping good records, I think, is part of that. But I think also being very clear what each person's role in the business is, and keeping track of how that changes over time is also important. Let's look at the difference between succession planning and estate planning. Many people, when they think about transferring a family business, they're thinking about what's on the right here, the estate plan, and that's extremely important. This is the process of accumulating, conserving, and distributing one's assets during the lifetime. So how do we transfer the assets effectively from one generation to the next, to the family members that are going to be part of the farming operation, but also to the family members that are not part of the family operation. This is very important because it avoids surprises and helps mitigate conflict. The transition planning team at Purdue is more involved in the left-hand side here, and that's the succession plan. This is the orderly transfer of business ownership and business management from one generation to the next. And so I think in many ways the succession planning needs to come before the estate planning. We not only need to know how we're going to transfer the assets to family members or the younger generation, we also need to think about how we're going to orderly transfer this business ownership, and so that the family members that did stay on the farm know where they're at and have some signals that this is going to work. And so I think the succession planning in many ways needs to come before the estate planning. But nevertheless, both of these are extremely important. And this distinction is important today because we're going to focus on the left-hand side, the succession plan, specifically related to compensation of the family members that are involved in the business. Mm-hmm. So let's look at two different systems here. As I indicated earlier, farm families have both the family aspect and the business aspect. The problem here is sometimes the goals are conflicting. And it's important to understand this and think about this when you're thinking about succession planning. This is a fact. It's just something you have to deal with. The family tends to be inward looking, where the business has to be outward looking, and thinking about how we need to make some changes. How, for example, if we're going to grow, how are we going to do that? Are we going to add new enterprises? Or are we going to expand the enterprises we have? That's outward looking. Looking at the markets and seeing what opportunities are out there. That's much different than the family situation. Quite often, some family members in particular are very risk averse. Mm-hmm. And the business really can't be that risk averse because it needs to grow, it needs to look at opportunities. Many times these new opportunities involve quite a bit of risk. And so that's different. The family focuses on emotions sometimes, where the business focuses on what needs to get done. That's why these job descriptions are extremely important in family businesses, even if it's just an outline of what each person's role is in the family business. We're not going to talk about this today, but when you're talking about business management transfer, for example, and you're bringing a younger family member into the business, it's very important to figure out what their role is going to be and what their responsibilities are going to be in that family business. Many times that'll start out relatively small. Maybe they'll be in charge of just a small tract of land, or maybe they'll be in charge of one of the quad buildings on a contract swine finishing operation. Usually that starts out relatively small and expands from there, but it's very important that we have clear rules of what the different family members are going to do. And sometimes in families that's not so defined, and it doesn't necessarily need to be. And
sometimes it's just by default.
Yes. The family seeks stability. Most families like stability rather than the converse, and so that's important to families, where the business has to seek change, as I indicated earlier. The family does not necessarily count cost. The business has to track costs. It has to track net returns, and many times those net returns are divided among the family members as an important part of their compensation. So it's a very important, Denise, to be able to track those things. And one of the things that you do teach is record keeping, and so you get involved in that quite a bit. Do you typically see people that have separate checking accounts for the family versus the business?
I see some of both, and I highly encourage them to have a separate checking account for the business, because it's so hard to keep the family expenses separate if you don't have a separate accounting system.
Yes. And many think, well, the tax implication is going to be different if I have two separate checking accounts. Yes and no. Taxation is a separate issue, but knowing exactly what the family's spending money on compared to the business is extremely important, because again, if the business has several family members in there, we need to clearly have a clear indicator of what net returns, profitability, earnings are, so we can divide that among the family members, and there's no questions. Mm-hmm. Everybody should have transparency there in terms of how profitable the business is. So let's just spend a minute or two comparing the family system and the business system. There's quite a few attributes of a successful family. This is just some of them. The point I want to make here is these attributes are quite different than the attributes of a successful business, which I will show on the next slide. So you can go down the list here: loving, loyal, affectionate, supportive, empathetic, understanding, enduring. Communication is very important in families, and we'll talk more about that a little later. Contrast that with the business system, where you have words like efficiency, profitability, goal-directed. None of those words were in the previous list for the family, and so sometimes the goals and the attributes of what it means to be successful are quite different. That's why we have to think about this separation between family and business, and that's why this whole issue of compensation is so important to get that figured out early on when a family member is coming back to the business. In fact, I think it's important to communicate that before they come back. Just sit down and hash that out a little bit on what the compensation is going to be if a particular family member does come back to the business, because that's going to be very important to the success of the business. If their compensation is too low, then we need to talk about that and seeing how they're going to be compensated long term for the fact that their salary is relatively low. If their salary is relatively high, that's going to put a burden on the business, and the business is going to have to be bigger in order to support that larger salary. And so because these attributes of successful families and businesses are so different, we need to try to separate the family and the business sometimes when we're thinking about things like compensating family members. I have to admit, Denise, one of the reasons that I talk about this is I've seen situations where people don't think about this beforehand and they run into problems. They thought that they were going to be compensated in a certain way. That didn't turn out to be the case, and it's always best, I think, to communicate ahead of time the way this is going to work so that we don't run into these brick walls and run into some big problems. Another thing I want to talk a little bit about: the structure of the family does not change. So the family tree is even though you might want it to change, sometimes the family tree does not change. The business has to change over time. The organizational chart is going to change. You're going to have different family members coming into the business. You're going to have people leaving the business. They may leave early before they retire. They may leave when they retire. So changes are occurring there. But also, as a business grows, many times there's hired employees. And so that changes and changes the organizational structure. And so again, succession planning is really involved in the planned change of the organizational chart. And so we talk about things like compensation of family members, compensation of employees. We also talk about management responsibilities of the different family members. Again, contrast that with estate planning, where you're talking about how we're going to divide up the assets, at the end of someone's life or when they retire.
So how do you define equal or fair?
That's a very difficult question, and I'm not trying to get out of answering the question, but this really varies considerably among families. What one family considers fair or equitable is going to be completely different than what another family considers fair and equitable. There's a lot of criteria that get involved here, and I'll show those on the next slide. But really, what this comes down to is the older generation needs to think about this independently, if they will, before they talk to the younger generation. They kind of need to think, what are some of the needs of the different family members? Do the family members have different needs, and then think accordingly, how they're going to compensate the family members that stayed in the business versus compensating the family members, maybe in the term of transferring assets later in their life to the individuals that did not stay with the family business. And so this is just kind of a short list, just stating the obvious that all children are different and have different needs. They have different motivations. It depends on what the off-farm heirs perhaps decided to do with their life. I think that sometimes is pretty important in terms of how they're treated, but likes and dislikes. Maybe some of them don't want to be involved in the day-to-day part of the operation, but they want to come back to visit. They want to have at least some role with the family business, and maybe they want to invest in the family business. I always think that should be encouraged. If a non-family member that has a job off the farm and wants to invest in the business, give them an opportunity to do that. And so every child is different, and these need to be taken into account when we think about compensating the family member that stayed in the business. And so just to repeat something I said earlier, when we're thinking about succession planning, we're often thinking about management transfer in addition to compensation of farm employees. Here we're focusing on compensation of farm employees. Maybe in a future webinar we'll talk about management transfer, management responsibilities for the family members. Before we can really start talking about sweat equity or looking at sweat equity, we need to think a little bit about dividing business income. And there's quite a few farm management publications related to dividing business income. Here I'm taking some information from an Iowa State publication on dividing business income. And this publication had a couple different methods they talk about in terms of dividing business income. These methods have some similarities to them. Let me just talk a little bit about these. And again, the reason I'm covering this is important when we're thinking about compensating someone that's staying on the farm. But before you get into the common income sharing models, one of the things to consider is perhaps having a testing stage with family members that are coming back to the farm, or having a stage where they're just treated as any other employee and just paid a salary. I think a testing stage is probably important before you get into income sharing models. And so let's assume that we've had this testing stage, and the person that came back to the farm is going to want to be part of the operation. So how do we begin to think about income sharing the income? A couple different approaches can be used here that we'll talk about on these slides. One is called the contributions model. Here, income is divided in the same proportion as the relative value of each party's contribution of resources to the business venture. Boy, that's a mouthful.
Yes,
let me put this really simply. Perhaps the older generation has land, so there's land, there's family land. Perhaps the older generation has most of the machinery, most of the grain bins, most of the buildings. They need to be compensated for the fact that they have this land, they have this machinery, they have these grain bins. The younger generation perhaps has a lot of energy, and they're going to provide a lot of labor to the operation. They're going to provide some management to the operation. They need to be compensated for that labor, that management, and that energy, if you will. And so that's how we're thinking about this. Let's don't make this any harder than it is, but just kind of list the key resources in the business, and then each one of those resources needs to be paid something for the value of that resource to the business. The 50-50 model has some attraction because here we pay each party a payment for those resources, and so land, for example, would get a cash rent. The machinery, there would be a rental value on the machinery that would be paid to the people that have the machinery. The grain bins, there would be a rental payment paid to the person that owns the grain bins. We'd have salaries paid to the people that are working in the business. If there's any remaining profit or loss after that, it should be shared equally. Notice I said profit or loss. In some years, when you make these rental payments, you're actually going to have a loss. 2015 in central part of Indiana, where it was so wet, there was probably cases where there were some pretty large losses. And so in those cases, the parties would need to share the loss. So the 50-50 model may not work quite as well for a younger family member that does not have the wherewithal to come up with the money when we have losses. And so sometimes the contributions model is a little more attractive to the younger generation because they can't come up with that money if we have losses like we did last year in central Indiana. So let's talk a little bit more about how this works. So let's look at some of these assets. I've talked a little bit about this already, but let's take a look at this. Some of the assets that would need to be paid an annual value. Land and buildings are usually pretty easy. There's cash rental markets in most areas, and so we know what the land is worth in many cases. Machinery and equipment machinery, equipment, and livestock, the same is true there. Put a value on the machinery and equipment, charge a rental value for that machinery and equipment, make sure that the party that owns the machinery is getting compensated. Working capital. What is working capital? Working capital is for a grain farm is the grain in the bin. For a livestock farm is the livestock on the farm if you own the livestock. In a contract, quite often you don't own the livestock, so they would not be working capital. What working capital is cash, grain inventories, supplies, things like that. And quite often that is not shared equally. Again, the older generation quite often has most of the working capital that's used for the business, and so they need to be compensated for that. So charged an interest rate, if you will, for their working capital. And then we come to labor and management. So put a value on each of these resources and pay people accordingly. Where the sweat equity comes in, Denise, is where the labor and management is paid a very low salary compared to what they could get elsewhere. In many cases today, many of the people that are coming back to the farm have quite a few opportunities to work off the farm, and if they're coming back to the farm may not be able to or may not want to, whatever the case is, pay that salary that they get off the farm, and so they're paid something less than what they could get off the farm. That's where the sweat equity really comes in, and we need to think about what's that worth and how should that be taken into account when we're thinking about dividing up the assets when the older generation retires. Net income is shared in the same proportion as each party's respective contribution to the resources. In that case, the 50-50 model is very similar. We have these rental payments on these different assets, just like you have with a contribution margin. But here we share equally among the parties if there's any money left over. With the contributions model, what you tend to do if there's a loss in the business, each of the resources gets paid less than it would otherwise. With the 50-50 model, we pay the resources as close as we can to what the market rate would be, and then share any remaining loss. And so I think again for the younger generation, the contributions model works quite well. But again, that's usually after a testing stage where they're paid for a while, just as a hired employee.
Yeah, to make sure that they're going to stay.
Make sure they're going to stay in the business.
So how do we put a value on that lower salary? We've got a family member that's come back to the farm. They may or may not have gone to college. They could go to town and get a job that pays much more. Their heart's at the farm, but we can't afford to pay them much.
This is a very difficult question, but what we're going to try to do here is walk through possible ways to think about it, because I think rather than getting into the numbers right away, we need to think about a process. Think about a way we can think about this and get a handle on this. And essentially what we're going to do here is walk through an example here in a couple of minutes. And one of the things to think about is in addition to how much we've paid this family member that came back to the farm, how much is the equity increasing? Because the person came back to the farm, and how much did the equity increase specifically the year they come back compared to the year that the older generation decides to retire. If that's a substantial amount of money, what we're going to indicate here is part of that increase, it really needs to go to that younger family member that stayed in the business. Maybe not 100% of it, because we know there's other factors that create equity, such as land values do go up over time. Was that necessarily because the family member was there? No. Land goes up independently of the family member coming back to the farm, and so probably not 100% of that increase in equity is due to that family member, but certainly a portion is, because holding the business together makes it worth a lot more than what it would be if we just sold the assets.
Or business expansion.
Yes, and so looking at the change in equity or the increase in equity from the time the family member joins the business to the individual's retire, or the older generation retires, is that's what we need to get a handle on. Is what is that equity increase, and how much of that should go to the person that came back to the farm. So let's start about where does this term even come from? It comes from what we've been talking about when we're thinking about contributions of an on-farm heir to the value of the family-owned business, and specifically when they're paid less than what they could have got working someplace else. And in most of the cases I run into, that is the case. Mm-hmm. They are paid less than what they could get working off the farm. I ran into a few cases where they actually get paid really well. Then the sweat equity this discussion goes away. If they're fully compensated for the opportunity cost of opportunity cost of the amount of money they could get working off the farm, if they're totally compensated for that, sweat equity is immaterial. Mm-hmm. But for all those other cases, which is the vast majority, where they're paid a lower salary, sweat equity arises. And so it arises when an on-farm paid is less than what they could get elsewhere. That introduces this idea that economists love to talk about opportunity costs. This term also arises in situations where the business has grown substantially. Many times when a family member comes into the business, one of the first things that the family business starts looking at is, can we rent additional ground? Can we buy additional ground, either the older generation by themselves or the younger generation with the older generation? So we buy assets. We grow the business. And so this idea of sweat equity is really a combination of relatively lower pay and also situations where the business is growing very rapidly. I know some situations in Indiana and the Corn Belt where we're not just talking about one family member coming back. We're talking a lot of family members coming back. And so the business looks vastly different from one decade to the next because we continually add family members to the business. And so somehow we have to think about how we're going to keep track of this. And so I'm trying to think of a logical way to do that, and that's to think about how much was the compensation compared to what the individual could have got, and how much is the increase in equity that results from the individuals coming back to the family business. So let's get into our example here. I want to give credit where credit is due here. David Geller at the University of Nebraska-Lincoln wrote a publication for the University of Minnesota that's related to sweat equity, and I've adapted his example for the example I'm using today. It's not exactly the same example, but I've adapted the information he had to come up with this example. I've changed some of the numbers and of course changed the names involved. So putting a value on sweat equity, and so this is the meat of the webinar, if you will. So let's look at a family situation, and we'll illustrate a few key points. And believe it or not, we're keeping this relatively simple, Denise.
Yes, we are.
It can get much more complicated. We'll talk about some of the complications here at the end. So mom and dad want to keep the farm in the family. So one of the simplifications here, we don't have uncles, aunts, so on. We just have mom and dad. If you have uncles and aunts, then it gets more complicated. So just there's three children, and Michael is the only child that wants to come back to the farm. He came back to the farm in 1990. If the business was divided in three equal pieces, that's something the older generation could have done, and decades ago that was common.
Very.
If you had a large family and you had quite a few sons, you divided the business, amongst the children. In fact, my grandfather's family many years ago in Nebraska, that's how they did it. They split up the farm into many chunks. Unfortunately, the youngest members, they ran out of chunks, and so
the same thing happened in my parents.
If you have
my
10 plus family members, maybe the first three got a part of the chunk, and then the rest did not. But that's how we used to do this. But with today's farms, that'd be very, very difficult to do that. And so we want this business to continue without having to sell the pieces. And so that's what we're talking about here today. None of the pieces would be of adequate size, but even if they were an adequate size, to me it wouldn't make a lot of sense to divide it into pieces anyway. Mm-hmm. So when Michael came back to the farm in 1990, the fair market value of the business was $420,000. This is land, machinery and equipment, grain bins, working capital. This is everything, fair market value of the business. This is the equity. I should have been a little more clear on that. This is the equity that was in the business in 1990, $420,000. Now, of course, land was not valued near as much as it is today, and so that's why the value is quite a bit lower than what we're going to see here when we look at today's value. At the time, mom and dad agreed that the contribution of each child up to 1990 was equal. And so they've made a decision here. One of the ways they're going to divide the income at retirement is they're going to take a snapshot of what the business looked like in 1990 and divide that $420,000 of equity amongst the children equally. I think that's logical. So each child in that case would get $140,000. Now let's think about what we're going to do with the increase in equity from 1990 to today. And we're going to see that's rather sizable. But if you think about what land values have done since 1990, they've increased rather dramatically. Machinery is much more expensive than it was in 1990, on and on down the list. And so the business is worth considerably more than $420,000 today. And so that's really what we're dealing with, is how do we come up with a value for that increase in equity. So today's fair market value of the business is $1,680,000. Again, this is not extremely large by today's standard, but that's what this particular business is worth. If we divide this in three, each child would get $560,000. However, the contributions of the three children have certainly not been equal since 1990. Michael came back to the farm. We're not going to talk exactly what his salary was, but let's just assume it was considerably below what he could have got working off the farm. And so he basically worked for a lower salary. And so you would think it's logical to think that part of this increase in value from $420,000 to $1,680,000, it was due to him coming back to the farm. And so we need to think about how we're going to divide up that increase in equity among the three children. Now, Mom and Dad could say that all that increase should go to Michael. What's the problem with that, Denise? You think of a problem?
Yeah, I can think of a big problem there. Mom and Dad are still involved, and
Yes.
they still have equity in the business.
Yes, that and was that appreciation of it? Let's say part of one of the big assets here, which it is on most farms, is land.
Yeah.
Was that appreciation of land due to Michael's effort?
No, it really was not.
It really was not, and so certainly his coming back to the farm was important to the equity increasing, but it wasn't the sole reason why the equity increased, and so this is where the complication comes in. It would be simple to say, Michael gets 100% of that increase and leave it at that, and if the older generation could do that, they can do whatever they want to do. We're just giving you some, that's how whatever they think is fair is fair. And the family needs to accept that. But let's assume that part of that increase was due to outside forces, and so we want to put a value on how much of that increase was due to outside forces and give a portion of that increase in equity to the two off-farm heirs. So when Michael came back, there was few promises made. However, decisions were made because he came back. Some land was purchased, some ground was rented. Now, when we're talking about increase in equity here, we're not talking about any land or assets that Michael owns by himself, or portions of those assets that Michael owns with Mom and Dad. We're talking about Mom and Dad's equity here. We're not talking about Michael's equity. So that's very important to understand that if Michael bought 80 acres or 160 acres or whatever the case may be, that's outside of what we're talking about here. If Michael paid for portions or all of tractors, combines, planters, those are outside of the assets we're talking about here. And so let's be very clear about that.
So should we put these promises in writing?
I definitely think there probably needs to be something in writing in 1990 or shortly thereafter that talks about how this is going to be handled. Let's don't surprise everybody at next Christmas. Everybody's there for Christmas dinner at Mom's house. Let's don't surprise everybody over the Christmas dinner and say this is our plan. And so having some transparency as soon as Michael comes back, I think it's important for everybody. It's not just Michael. I am an off-farm heir, and so it's important for everybody involved that they understand what Mom and Dad's plans are. And so yes, there needs to be something in writing as early as 1990. And in 1990 might have been too early because we need to have maybe a year or two or maybe a little longer to make sure Michael's going to stay there. But as soon as we figure out that there's a pretty high chance he's going to stay, then we probably need to put some of this in writing. So that's a very good point, Denise. Mom, Dad, and Michael know that his contribution to the family farm has resulted in Michael developing sizable investment in sweat equity. So that's where this term comes in. We've got this increase in equity, and we need to figure out how much of that is Michael's. So there's two dilemmas in this case. One dilemma, mom and dad want to treat each child fairly. So they want to give something to the off-farm heirs, partly coming from that initial equity, partly coming from the increase in equity from 1990 to today. That's how they want to do this, because we know that farm assets have increased dramatically, particularly the land. Land on many balance sheets is 75 to 80% of the farm assets or the equity, and so that's the big asset we're talking about here, but there is other assets. And so let's talk about a couple different dilemmas. First dilemma here is we don't want the non-farm kids to feel that they have been mistreated or slighted, but if you were to divide the farm business in equal pieces, would each slice be large enough to create a viable business? The answer is clearly no. And so just like in 1990, it would have been a mistake to divide the business into three pieces. For perhaps a different reason, we wouldn't want to do that today either. One reason we wouldn't want to do that is, first of all, Michael probably deserves more than a third because he came back to the farm, but also Michael may have some heirs that want to farm. And so dividing this into three pieces again may not give him a viable business to hand over to his children. And so there's a lot of reasons why dividing this into three pieces is not a good idea today, just like it was not in 1990.
Or even enough to live on.
Yes, it might not even be close to enough to live on there. Mm-hmm. What about the contribution of the farming child to the growth or success of the business? We've been talking about that, and so we need to put a number on that.
So should Michael buy his parents out?
That's a good question too, and I get that pretty often. My answer is it depends on the assets. If it's land, I think as long as Michael has control of that land and can rent that ground from his mom and dad, I don't see any real reasons why it's urgent for him to buy that land from his parents. If he has extra cash or he has cash available, he would be better off using that cash to rent additional ground or buy additional ground outside of the family. If it's machinery or it's grain bins or something like that, then I think it's a little different answer. Then I think perhaps he should consider perhaps slowly but surely buying some of those, buying some machinery, buying some of the grain storage from his parents. And so I really think it depends on the type of assets you're talking about. But certainly, I think the day's over. That again, decades ago, farm families used to do this, where the younger generation would just simply buy the assets from the older generation. I think those days are over to a large degree because it takes so much cash to do that. And because the older generation is living years after they retire, and maybe dad wants to continue to farm with Michael for a while, because people are living quite a while, they need sources of income too. In my mind, land is a really good source of income to the older generation. They're receiving that cash rent, and so that's a good source of income. And so as long as Michael has control of the land, I don't see any real burning reason why he needs to buy that asset. And if his sisters are probably going to inherit cash and or land, probably some of both. If part of the increase in the equity is given to the non-farm heirs, may not be sisters. I shouldn't just say they're sisters, but they also Michael needs to know from those non-farm heirs that he can rent from them. So hopefully that's the case, and hopefully there's been something in writing to that extent that he's going to be able to rent from them when they inherit the land. And then again, that's a good situation for Michael. Why try to buy his off-farm heirs out when he can use that cash to expand and buy additional
and grow
land,
his personal business.
Yeah, grow his business. And so some very good issues there. So what's the resolution here? Now, we're going to make this fairly simple. I know it can be a little more complicated, but after careful consideration, Mom and Dad have decided that they would equally divide the 1990 value of the farm between the three children. I think that's logical. Again, they don't have to do this, but this is I think this is fairly logical. That means that all three individuals will get part of that $420,000. They've also decided, this is where it gets a little more contentious, a little harder to figure out, that Michael was responsible for 50% of the growth since 1990. You're gonna ask me, how did I come up with the 50% here? I think Mom and Dad have to think about this. That, I don't. There's not a clear way to do this, but I think it's important that a portion of the growth needs to be attributed to Michael, and a portion needs to be attributed to outside market factors like just appreciation of land. And so it is hard to come up with exact figures. That's why I've used 50%. And so 50% of the growth since 1990 was attributable to Michael, and so he's going to get a larger portion of this $1,260,000 than the two off-farm heirs, because he's responsible to a greater degree for that increase in equity. And so how does this all play out? Michael receives $980,000, $140,000, that's the original one-third of the 1990 value, 50% of the growth. So that's where his $980,000 comes in. Plus he gets one-third of the parents' contribution to growth. So the parents, the outside factors, our outside forces were responsible for 50% of the growth. He still gets a third of that. And the sisters get the other 2/3, or the non-farm siblings. Non-farm siblings get the other 2/3. They get $350,000 each, $140,000 of the one-third of the 1990 value, and then they get a portion of their parents' contribution to the growth, or $210,000 in this particular case. And so notice what we're doing here in terms of dividing the 1990 equity up among the three children, but also the growth up among the three children, and using this 50%. Michael's responsible for 50% of the increase in equity from 1990 to today.
So as the parents have come up with this plan that this is how they're going to divide things up, should they keep everybody informed, or should they just spring it on them when the will happens?
I think slowly, after 1990, whenever we figure out that Michael's going to stay on the business, I think they need to start thinking about this formula. Now, things may change over time. Land usually goes up, but not always. We've seen that in the last 2 or 3 years. Land's actually been declining in value, and so things do change over time. But I think when they come up with the original plan, shortly after 1990 there, they need to be transparent with all the family members. But I think also as things change, if something changes, they need to be transparent with all the family members. And I think it works best, and they can do this however you want. I think this works best if you talk to each of the family members separately and then as a group. Some family members, some families like to do it just as a group. I think that's up to the family dynamics. But I know in my case, my parents talked to each family member separately and then as a group, and that worked well for our family. And so every family does it slightly different, and each family needs to figure out how they're going to do that. But don't make this a secret, or don't spring this on the family members at a major holiday, and so people leave angry and so on. I mean, there's going to be some people angry probably anyway. And sometimes the family dynamics are difficult, but nevertheless, I mean, you don't want to spring any surprises on anybody. And it isn't always easy for Mom and Dad to come up with this plan either, because sometimes Mom and Dad don't necessarily agree, initially at least, on what the plan is going to be. I've seen a lot of cases where, for one of the older generation wants to give most of the assets to Michael, the other one thinks they need to divide it equally, and then they need to come to an agreement maybe in the middle someplace. And so this assumes that they've Mom and Dad have come to some kind of agreement, and that's again why it needs to be transparent, because we can't just assume that this is going to be easy to do.
Right.
Yeah. When Dad's has a stroke and something, and then we say, oh, about time we started thinking about this. Let's do this before we run into major health issues. And so so if something comes up, we know what the plan is. It's one less thing to worry about when someone's health starts to deteriorate. It's one less thing to worry about is the estate if we have some planning early. So then, no, that's a very good point. So kind of the lessons here of this example: the family business looks different today because Michael came back to the farm, and so we're trying to reflect that in his compensation. let's summarize. You got part of his compensation salary, maybe partnership income, whatever the arrangement was there, or corporation salary, corporate salary. But part of his compensation was salary while he was farming. Part of his compensation comes when the older generation is deceased or is entering retirement and wants to settle the estate. And so his compensation came in two forms there. So that's what we're trying to figure out. Caveats. It is often difficult to determine how much sweat equity contributed to the increase in the value of the business. I talked about this earlier. The important thing is it's not 0% and it's not 100%. That's why it came with something in the middle. But each family needs to think about this. And you know, they know Michael better than we know Michael, and so they need to think about, was Michael a hard worker, and did he contribute a substantial portion to the increase in equity, or did he not work so hard and maybe didn't deserve 50%? Mm-hmm. So each family is going to be slightly different, and they're going to have to come up with that increase in value. But don't, just because that number is hard to come up with, doesn't mean you don't need to come up with a number.
Right. You've got to start somewhere.
Yeah. I'm going to check some emails here real quickly, and then we can finish up the webinar too. So while I'm checking some emails here, let's talk about some other issues that may come up. Obviously we didn't cover everything in here, Denise. Is there some things that we may want to consider in some family situations?
I think sometimes, and it's somewhat of a different topic, but we want to consider the fact that not only record keeping as far as the business is concerned, but we also want to consider family meetings so that everyone is kept informed, even the people, especially the people that are on the farm working, so that we know what the expectations are. You referenced job descriptions and things like that. Those of us that work off the farm, we work with job descriptions just like you and I do all the time. Yes. But those of us that are the people that work on farms, a lot of times don't have job descriptions, and sometimes that's very important to know what the expectations are. Definitely, and there's some issues that we have not covered here today, and so if there is some issues that you want to ask us about, by all means do that. But one of the issues that does come up quite often in families that we purposely left out of this example, but we know it's an issue, and it's come up in my family situation, is the on-farm heir may be the only person that's available to take care of the older generation. Mm-hmm. They might live right next to them, and so they may need to take them to the hospital, to doctor visits, to mow their lawn. There's just on and on and on. Yeah. We know how families work, and sometimes the older generation has some health issues. They can't do some of the things they used to do. Maybe having that on-farm heir there allows them to stay on the farm longer. All of these things are worth money, yes. And I think it's important to adjust that percentage of for Michael accordingly. Mm-hmm. There's no easy way to come up with those values again, but I think it needs to be in the thinking of mom and dad when they are coming up with this percentage, that percentage of the equity that is attributable to Michael. Mm-hmm. We don't have any questions right now, but I think we've addressed quite a few questions during this webinar. And again, if you have some questions later on, by all means, email those to me. I do want to put a plug in for our upcoming webinar. We've been having quite a few webinars recently, and we have one coming up in about 3 weeks, September 13th. And this is going to cover the crop report, major crop report that's coming out on September 12th. And so we're going to cover that crop report and give an update on crop outlook with Chris Hurt, Jim Minard, and myself. And so with that, please join us for the next webinar, and thank you for joining us today.